Welcome to Frontier Review's webinar on our Central and Eastern Europe outlook. I'm Mark McNamee, the Director for Europe here, and before we get started, we realize that some of you may be new to Frontier Review, so we'll just take a quick minute to provide you with a very brief overview of our firm and how we work with executives at major multinationals. Frontier Review provides the world's best market intelligence and advisory services for global business professionals. We help our clients grow and win in their most important markets by informing and powering the market monitoring, planning, execution, and other critical decision processes of our clients. With continuous research and insights, custom solutions, and transaction support services, we provide our clients, a small sample of which you can see here, with timely, actionable insights to adapt and win in changing markets. If you're not a client and are interested in receiving a 60-day complimentary access to our Frontier Review program, please leave a comment in the chat box or email us at info@frontierview.com. As part of our offering, we also have launched the new mobile app, Frontier Review mobile app, which is available on both iOS and Android, includes all the relevant content you need to monitor your markets, including this webinar recording and presentation deck. We encourage you to download the app to have access to these insights and more at your fingertips. Current clients can access the mobile app using the same login information as our browser application. If you are not a client, you can still download the app and monitor up to 5 complimentary countries and access other features like daily news and notifications. That said, having briefly introduced our company, we'll now take a moment to introduce our presenters, one of which includes me, Mark McNamee, the Director for Europe. And also joining me on today's call is Martin Belchev, who is our Associate Practice Leader for Central Europe. And the two of us will be sharing our insights on macroeconomic and policy develops for the upcoming year of 2022 across the Central Europe and CIS region, which includes the markets and regions that are noted here. If there are any insights you see today as part of this discussion or have any questions we do not get to answer, we will be happy, of course, to follow up with you directly following the webinar. So with that, I'd like to quickly walk you through the agenda. So as you can see here, we will start naturally, as many of you know who have worked with us, with the global context, sort of at the 30,000-foot view, then dive down deeper into the more regional context of the entire Central Europe and Russia CIS overview, then dig deeper starting in the east with the Russia CIS outlook, and then Martin will finish up with the Central Europe outlook, and of course we will address any questions that may come up during the presentation. So with that said, let's move into the global outlook. We have a lot to cover, so I'll try to go through this relatively quickly with the generally positive news. And you can see the very fast uptick, particularly in Western Europe, over the last 3 to 4 months of vaccinations. Started in the United States and UK at the beginning of the year, and then we saw a massive pickup across Western Europe. The very positive news about this means that we are seeing, as a result of the improved vaccination rates, a general normalizing of the global economy. As we already saw China and Asia come back online towards the end of last year, early this year, the United States has already recovered, statistically at least, from the pandemic, with a full recovery of all the lost growth of last year. And then also, now we're seeing Western Europe. Likewise, I'm sorry, I understand that there were some issues with the deck, so I believe it should be visible now. Regarding the vaccination rates that we have seen this massive improvement that as noted. The positive news means we are seeing a restoration of the global economy with China, United States back to pre-COVID levels, and Western Europe moving towards there and seeing a revitalization back to pre-COVID levels by the end of next year, thanks to the fast uptick in vaccination rates. The other side of this is that we're seeing, with revived demand, matched with issues on the supply chain side, a swift uptick in commodity prices and food prices, which is driving quite high global inflation rates, which we will discuss here. In terms of real GDP growth rates, US and China have been, as mentioned, recovering quite swiftly out of the pandemic, and therefore we are seeing, with these two markets already existing as the safe haven markets globally speaking, we have seen these two markets attracting most of companies' attention and resources and investments in 2021 and looking into 2022, though firms, anecdotally from speaking with them at least, are clearly looking for other sort of surprise regions which can help support the overall global portfolio. But to get an idea here, looking at, we've sort of separated out CIS from Central Europe. CIS and Central Europe were, again, relatively resilient compared to a lot of much of the world, particularly Western Europe and Latin America, and then also continued solid recovery this year. CIS has basically recovered from the pandemic, as has Central Europe. So quite positive growth story there, and then resilience into next year as well. When you look across the entire EMEA portfolio, you get an idea here. We pulled out Russia, Poland, and Ukraine, 3 of the largest markets within the entire region. Again, performing relatively well compared to most emerging markets. Russia actually had very surprisingly high Q2 performance, which has actually helped drive up our expectations for growth this year, though again, moderate slowdown into next year as we see a lot of structural weaknesses holding back Russia's ability to accelerate growth. Poland, on the other hand, we are seeing a bit of an acceleration, which Martin, of course, will dive into deeper. 2022 and 2023 look very appealing for the Polish market. As mentioned regarding the commodity prices, as we've seen demand sort of surprise to the upside across many of these markets that we've mentioned here, including the United States and China, that's half of the story of what's driving these commodity prices to be considerably higher. The other half of the story, which is fundamentally why we have actually raised our expectations, not only for this year, but also for next year for energy prices, relates to the supply side. So we've seen continued compliance by OPEC members, continued loosening of production quotas, but still compliance overall. And then critically, the most important point is that we are not seeing United States shale production reviving back strongly despite the elevated prices since the beginning of the year. This delay in investment then has caused a delay in output, so we're not going to see actually a tangible impact from US shale output until the second half of next year, leaving energy prices quite elevated through the first half of next year and even into Q3 as well, as demand continues to solidify around the world. So this is going to drive up energy prices. The impact is quite different, of course. Central European markets are going to continue to experience a little bit more elevated imported inflation because of the supply chain issues, because of these high energy prices, these high commodity prices overall. And this will also be the case driving up prices in Russia and CIS markets. However, those countries as energy exporters are benefiting massively from far higher than anticipated energy prices, which is obviously driving much stronger than expected budget revenues as well as spending, helping support demand across the economy this year and next year as well. Speaking of the commodity prices, again, as mentioned, that's why we've seen, when you look at sort of the index start of late 2019, this massive uptick, 200, 250%, in some cases even for as an example in iron ore, acceleration in prices. The positive news is that we see maybe in July, maybe in August here, to have seen maybe the peak of these commodity prices. As we're seeing some COVID restrictions being lifted around the world, bottlenecks being softened. So now we're starting to maybe see that peak, and so we could see a slowdown and we could see subsiding commodity prices moving into the beginning of next year. Companies should not expect really a significant sort of relief in terms of prices regarding commodities through the end of this year, but we'll start to see some softening more substantially as we proceed through the first half of next year. Similarly, again, part of that reason what we're driving up those commodity prices relates to the logistical issues of bottlenecks at ports in China and in Brazil and in California, et cetera. And so these issues have considerably driven up. In some categories, we're seeing 4, 5, 6 times the price of compared to pre-COVID times of shipping certain product categories around the world. Again, this is not going to subside really until probably the beginning of next year, and it'll take a few months into the beginning of next year to see a more swift sort of reduction in these shipping prices. Now, aside from that, another issue related to cost pressure, a bit more on the positive side as it pertains to the markets we're talking about today, does relate, generally speaking, to euro developments, and we'll also talk about the pound. So against the dollar, we are seeing, or we are expecting to continue to see, further strengthening of the euro next year. Nothing dramatic, but continued mild, generally stable appreciation of the euro across the year as we see the Western Europe economy further normalize and improve across 2022. This will, of course, help keep down, right, some of those imported prices and therefore help tame some of that inflation. Into 2023, prices will very minimally, again, generally stable, but minimal depreciation as we see the US Fed increase interest rates about a year at least before the European Central Bank increases interest rates. So the underlying story here is general stability for the euro, mild appreciation. We'll likewise see Central European currencies, many of them mirroring that appreciation of the euro against the dollar, and therefore general stability more or less against the euro. So should not impact trade terms particularly much, and should also help alleviate some of the price pressure next year. With the pound, we will see more depreciation consistently. Next year, continued depreciation as a result of economic weaknesses stemming from Brexit, and then likewise into 2023 as the US Fed raises interest rates. This, of course, will then see the Central European currencies importing from UK see even stronger appreciation of the currencies against the pound, helping keep down that price pressure. So generally positive news when you look at sort of the global currency environment as it pertains to the markets that we're discussing here today. Looking at the general overview, we'll of course sort of start with the restrictions. As you can see here, we pulled out some of the major markets, a general relaxation across the region. We do not anticipate, whether in CE or in CIS, as our base case expectation, we do not see significant lockdowns, if at all, into next year as a result of COVID, despite the fact that some countries are struggling worse with COVID rates at the moment than others. So this is generally positive news. For the markets, we shouldn't see any really destabilization or derailing of economic prospects as a result of COVID. You can see this playing out here more specifically in terms of growth rates. First and foremost, this entire region has effectively already, probably by the end of Q2, recovered, statistically speaking, all of that lost growth of 2020 by about the middle of 2021. Very positive news when you compare that to other regions around the world.